Let's get to Marc Faber for more on today's Market Action. He is the editor and publisher of the Gloom, Boom, and Doom Report. He joins us on the phone. And Marc, guys in your position are paid to worry about things, worry about markets, but also externalities. Just tell us, what have you been, what's your analysis of what we've seen in Japan and how it affects all the different markets we watch?
Well, first of all, I think that all stock markets and commodity markets were due for a meaningful correction because we've doubled or more than doubled since March 2009. So any kind of event was likely to trigger a more meaningful correction. And I think this is an event that is most unfortunate, but obviously it's a catalyst for a global correction in asset markets, in particular, obviously, in Japan. Now, as an investor, of course, it's a human tragedy. And as an economist, you have to say, okay, we have essentially destruction in Japan, which will necessitate very heavy spending, reconstruction expenditures, that will be somewhat inflationary for the Japanese economy and somewhat positive for equities and certainly negative for JGBs. And in my opinion, in the long run, very negative for the yen. Now, can the yen, as a reaction, because everybody says, oh, the Japanese will repatriate and the yen will strengthen, so maybe the yen goes up first a little bit. But I think this is kind of a turning point for the yen, and that the yen will weaken, that JGBs will weaken, and that equities will go up. And purely as an economist investor, I would say this huge sell-off is an investment opportunity in Japanese equities, but if a meltdown occurs, then all bets are off. That is the big question.
What do you mean by that, Marc? What do you mean all bets are off?
Well, I mean, if a real nuclear meltdown occurs, then the devastation could be just mind-boggling.
And you're talking about you're talking about human life in Japan, or the markets, or both?
Human lives, the devastation of the economy, and obviously it would be a huge financial burden on a government that is already heavily indebted.
So Marc, then, if we had more clarity on the outcome of what happens with the reactors, you don't think that the equity markets in Japan would be acting this way? You think they'd already be looking beyond the tsunami and the quake and at higher levels than they are right now? And in fact, if it is resolved favorably, the nuclear outcome, then you think this is a time to actually be buying?
Yes, absolutely. But as I said, until you know whether there will be a nuclear meltdown or not, could take another month or 2 months. It can last a long time. You don't know. And we don't know whether there will be a second earthquake that has an even larger impact, can happen occasionally.
Well, that means that we've just entered a period where the markets are going to be hostage to the slightest incremental bit of information regarding the reactors. And that's
correct.
That's going to
I think it's healthy that the markets start to focus on something else than what Mr. Bernanke is telling the press all the time.
I'm not sure what they'd rather look at, Bernanke's code or the news out of the reactors.
But speaking of Bernanke, Marc, is there any reason to think that the Fed's accommodative stance is actually extended because of the initial event in Japan, just the potential for the global economy being weaker than expected? Would it make it harder for the Fed to pull back?
I think it will make it harder, but I think they will pull back until the S&P drops from peak to trough. In other words, we were at 1344. That was the high in February. And we may drop 10, 15%, and then QE3 will come, and QE4, QE5, QE6, QE7, whatever you want. the money printer will continue to print. That I'm sure.
So then you don't expect. That's interesting then. So it's not necessarily the worries about global growth, but it's based on where the S&P is, on whether the Fed continues to.
Yeah, I think Mr. Bernanke doesn't know much about the global economy, but he watches probably the S&P every day.
No. So you went all. What did you get to? QE8. I don't think anyone talked about QE8 yet, Marc. But I understand. You're somewhat tongue-in-cheek, but you don't expect June to be the end of the bond buying for the Fed.
Temporary. They will probably stop to, test the market, how the market reacts. But afterwards, I would fully expect more quantitative easing. There's nothing else they can do, actually.
Go ahead.
I was going to say, Marc, obviously for U.S. equities, does it now seem ludicrous to talk about a slightly improving jobs picture here, or does that still matter?
I think that in general the economy bottomed out and that we are in a mild recovery. The outlook for employment is not particularly good, but I think there can be an improvement. But markets are a discounting mechanism, and we've already doubled in the S&P from the lows. So on the improvement, maybe the market sells off.
Hey, Marc, what about commodities? And I see two opposing forces in what you're talking about. Number one is that if asset values come down, even when you're talking about stocks and equities, that will throw a scare into the growth prospects for the globe. So I could see commodities coming down based on that. But you also think that the printing is going to continue full bore, so that'd be the opposite. But what do you think happens to commodities and oil?
Well, first of all, we have many different commodities, so each commodity is in a different position. In general, say, a nuclear meltdown or the accident that happened in Japan at the nuclear reactors is mildly positive for coal and oil, and negative, obviously, for uranium. And in terms of oil, I still think from a risk-reward point of view, it's a very attractive commodity because either you're very bullish about the world and everything is Goldilocks and everything recovers globally, the emerging markets grow, Japan, because of the reconstruction work, grows again, the US grows, and so forth and so on. So the demand for oil goes up and the supplies can't keep pace with the demand. Or you take an ultra-bearish scenario like I do, where you think everything will collapse and that there will be World War III and collapsing countries in the Middle East, and then the supply will be curtailed and prices will go up. So in either scenario, you're probably okay in oil. But I'd like to warn your listener that if oil goes to $200 a barrel, it is likely that there will be oil excess profit tax imposed by the U.S. government.
So just in closing, Marc, you figure QE2, they pretend that they're going to end in June, but then eventually they're forced to start it up again. And Leisman's here now. I don't know if he heard you say QE8, but you figure it restarts, and so it's
actually I made a mistake. I meant to say QE18.
QE18. Okay, so it comes back. It'll be here in 2012 as well, and maybe 2013?
Yes, for sure. But I'd like to make one point very clear. Until very recently, the Fed has had very few critiques. In other words, very few people criticized the Fed's policies under Mr. Greenspan and Mr. Bernanke. Over the last few months, a lot of critical comments have come up about the Fed and its money printing habit. But I bet you, the S&P drops 20%. All the critics will be silenced and they will all applaud renewed money printing.
Right. All right. Well,
sadly.
We always interesting, always stimulating. I don't know what Leisman still. You okay?
I'm a little stunned.
You're a little bit stunned. Anyway, let me say goodbye to Mark, and then we'll talk. We'll talk to him. Marc Faber, we appreciate your time this morning. Hope to check back with you
My pleasure.
again soon. Thanks.